India buys more than 85% of its oil from outside. Petrol got more expensive. LPG started costing more. What triggered all of this? Kargil, Russia, Ukraine, Israel, Hamas. Every single time markets panicked first, every missile fired in the Middle East is also fired at your portfolio. Is your portfolio built to survive it?
Iran and the US exchanged fire in the biggest escalation since the ceasefire began. Iran attacks US Navy destroyers and the US launches strikes inside Iran.
Every single time. In the last 60 days, your money may have lost value, even without making a single bad investment decision. Firstly, you would have seen petrol got more expensive, LPG started costing more, and then you would have seen your money losing value in the market. But how did a conflict thousands of kilometers away impact your portfolio in India? In this video, we are going to break down exactly this and explain how India got impacted by the US-Iran war and what history tells us about markets during such conflicts. Most importantly, how you should be reacting as an investor. Before we get to your investments, let's first understand what triggered all of this. See, on 20th of February, US attacked Iran and Iran did not stay quiet. They threatened to obstruct the Strait of Hormuz. It's a narrow waterway just 33 kilometers wide. But through this route, almost 20% of the world's oil supply flows through every single day. That's 1/5 of global oil supply moving through one critical route. Now, once this news spread, the markets went into a tizzy. Saudi Arabia got concerned because its oil exports also passed through the same route. And Saudi Arabia is one of the largest oil suppliers in the world. This fear of oil supply being disrupted caused the oil price to go up. And this is where it stops being a distant geopolitical event and starts becoming your problem. To give you an idea, India buys more than 85% of its oil from outside. And out of this, 45% comes from the Middle East. So when the Middle East gets unstable, oil prices rise. So every missile fired in the Middle East is also fired at your portfolio. This is where it starts hitting you. When oil prices go up globally, India has to spend more money to buy the same amount of oil. Our import bill becomes bigger because we are spending more dollars than before. And when we spend more dollars, the value of the rupee starts falling because we are sending more money out than what is coming in. Now here's a big catch. When rupee falls, everything that we import gets more expensive. Not just oil, medicines, electronics, raw materials, literally everything starts getting more expensive. And that's when inflation kicks in and starts impacting everyday life of people. In situations like these, gold has historically done very well. But this time, something very surprising happened. When tensions escalated, gold was at 1,58,585. Or you can take roughly 1.58 lakhs. 1 month later, it dropped to 1.42 lakhs. Since that time, it has already recovered to 1.54 lakhs. This is not the first time that India has faced a situation like this. Markets have faced conflicts before and they have reacted to that. So instead of guessing, let's look at what history tells us. Take a look at the pattern on your screen. During the Iraq war in March 2003, markets fell by around 5% at their worst. But if you had stayed invested, you would have seen nearly 71% returns over the next 1 year. Now look at another example. During the Crimea annexation war in March 2014, markets barely reacted. A small drop of around 2% at peak, and 1 year later, returns were close to 38%. Kargil, Russia, Ukraine, Israel, Hamas. Every single time, markets panicked first, recovered second. every single time. The investors who lost money were the ones who reacted to that panic, and the ones who stayed invested came out ahead. So in a world where one conflict can shake up your portfolio, holding something which is not volatile in your basket makes a lot of sense. As we're shooting this video, the situation is still not over. US has threatened Iran of yet another massive strike unless Iran opens up the Strait of Hormuz. That means uncertainty is yet to be over. Now, based on everything that we have discussed so far, there are 3 key takeaways that you should keep in mind. First, do not make an investment decision based on news headlines. Every war, every crisis, every conflict has felt like the end of the world at that moment. But markets have always recovered, always. Second, diversify your portfolio today. Diversification is not a fancy word. It is a protection. One can diversify his portfolio across many assets like stocks, mutual funds, bonds, bank deposits, gold, etc. Each one comes up with their own unique value proposition for your portfolio. More about their value additions and pitfalls in the upcoming videos. Third, volatility is not a threat. It is information. It is telling you where the risk is and where the opportunity is. The people who understood this in every single conflict came out ahead. The world will always be on fire somewhere. The real question is your portfolio built to survive it? Till then, stay smart, stay invested.
Fixed returns do not constitute guaranteed or assured returns. Investments in corporate debt securities, municipal debt securities, securitized debt instruments are subject to credit risks, market risks, and default risks, including delay and/or default in payment. Read all the offer-related documents carefully.